The views and opinions of this program are those of the hosts, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Well, at Wednesday's close, there was a lot more red than I would like to see across really the entire trade. Grains, livestock, outside markets just felt like a risk-off day in general. We're going to talk about that and some of the other features we are keeping an eye on across the trade here with Mike Zuzolo from Global Commodity Analytics. And Mike, thanks for joining us this week. Appreciate the time as always. Hope you had a good long weekend.
I did. Thank you, Jesse. And I hope you did as well with your new family.
I did the best I could. And of course, took some time on Monday to remember those who made that ultimate sacrifice for us so folks like us could have that long weekend. So I know definitely important for many people. We got back to trading Tuesday. Looked like a pretty decent day, especially feeders and everything else. And then what happened Wednesday? This market across the board just kind of fell apart, Mike.
Yeah, I think, the theme of today's conversation, I think, should be remember what got us here. I mean, and I think that wraps into, as you say, the Memorial Day holiday and how we got to where we are such a great country with the veterans and their families who paid the ultimate sacrifice. The markets, I think it's a similar mindset that what has gotten us here over the course of the last 40, 45 days has been two major sources that you and I have talked about quite a bit. One has been supply demand, the acknowledgement that wheat and grain supplies are tightening globally. But the other big driver, and maybe even the bigger driver, and the one that's even more important as we get into the middle part of the calendar year, as we get close to harvesting Northern Hemisphere wheat crops, and as we get close to seeing emergence in the row crops in the Northern Hemisphere, is that investment flow. And I think you nailed it when you said it seemed like a risk-off day. It felt like a risk-off day yesterday to me when the wheat and the soft red market was able to make new 2024 highs on continued bullish news with tighter Russian crop estimates and then followed by tighter Ukrainian crop estimates. And that allowed us to get up to that 720 level in the soft red wheat lead month futures. That's right around that 52-week moving average. That was kind of my marker that I laid down at the end of last week and Monday night with clients and subscribers on my email, Jesse, to say, okay, we got to get above this week. We got to keep the momentum going this week because we're getting ready for a big inflation report on Friday. I think the inflation report is what's really behind this risk-off mindset because these bond yields are really starting to get into our risk-on attitude, and I think commodity money is being pulled off the table right now.
Well, we got some charts to take a look at as always, and one of the big things you and I have been talking about with that wheat rally, and a lot of folks have been talking about this too, has been the lack of precipitation in the Black Sea region, Russia, frost damage, things like that. What's some of the latest you're hearing in terms of what we're seeing over in that region for wheat right now, Mike?
The crop is hurt. Ukraine is hurt. We're not sure how much yet by Ukraine, but with Russia, both ICAR and Soybean have come out and said, okay, 81 million to 82 plus million metric tons for 24 wheat. That compares to USDA's number earlier this month of 88 million tons. So we've got some crop damage. We've got India reportedly relaxing their 40% import tariff on wheat starting in June. Traders in India think that maybe they'll pick up as much as 3 million metric tons to replenish their domestic supplies. We've got a lot going for us on the supply demand side of the equation, not to mention those crop conditions ratings yesterday dropping a point. But I think what the trade's really focusing on, if there was one chink in the armor on the supply demand front, it is that the driest areas of western and north central Ukraine, Russia, are looking like they're going to get some really good rainfall totals, upwards of 2 to 3 inches expected in Saratov. That's kind of the nucleus and kind of the center part of the driest areas of Russia's wheat and crop belt. That would be that black earth area that we heard about getting frozen and having frosts and freezes. The USDA NOAA came out and said about since March 1, those precip levels in that area specifically about 33% of normal. This is a 7-day precip forecast
Mhm.
updated earlier this afternoon on Wednesday, and it does look like they're going to get some much needed rains, and that can get into some of the driest parts of Ukraine as well. It's not going to get much farther south than Dnipro, and looks like Donetsk, which is another key area to be watching, maybe won't get as much. So we still have a weather market in this area, but it's not as big a weather market. And in my opinion, Jesse, it's kind of like what we dealt with several months back. It's a great excuse to go ahead and liquidate your longs if the dollar's not going down, and if the ruble's going down and hitting towards monthly lows, which is what's happening here at midweek.
Well, obviously, with a risk off kind of pullback on Wednesday, how does that affect some of the charts? Let's pull up HRW chart and talk a little more wheat here. And I know in the case of the wheat markets, down moderately, I would say, on Wednesday. Your thoughts on this chart and any chart damage maybe that's been done with the pullback on Wednesday?
Yeah, the key with this chart is this is one that really led us in the right direction. When we were back sitting at the end of March, 1st of April, you and I looked at this chart and we said, okay, is it going to be 2015 or is it going to be 2009? And it looked like 2009. The fundamentals were pretty accurate with what we were dealing with. And that's indeed what has happened. And it's pretty amazing how closely this 2024 HRW market has followed 2009. We made a high on June 1 of '09, and we've been talking the last couple of weeks about changing the mantle, handing the baton over to the outside markets, to the dollar. The dollar needs to weaken. So if you're going to talk about the market being over with after June because the wheat high is in, or if you're going to talk about, and we'll look at this in a minute, if we're going to talk about the corn market being over with after June into July because we're going to see a weakening like we saw back in 2014, 2015. You're going to be saying that probably because the dollar's not breaking. And that's why I put so much impetus and so much pressure on the US dollar to find a break to the downside in that currency. And it's very important right here, right now, because again, what I'm saying to you today, Jesse, is why we're going down right now is because the Chinese have allowed the Chinese currency to make a fresh 6-month low as of the middle of this week. We're at new monthly lows in the Brazilian real against the US dollar. And so that helps explain why the soy is so weak. We don't want to go back to where we were back during that January, February time period. And that kind of would open back up and cause the market, I think, to resurface in their thinking that we're going back into deflationary mindset and the inflation bowl is over with. And I think, again, Friday's PCE numbers and then the OPEC meeting on Sunday, these are going to be two major linchpins as we open up a brand new month in June.
Speaking of corn, and I'll go to the next chart. This corn market, demand, corn, beans, wheat. I mean, everything U.S. demands just been ugly as of late. And I think corn is such a follower here the last few weeks. We saw corn move lower with wheat and beans on Wednesday. It felt like hit fresh daily lows, things like that. But looking at the Gulf corn price and things like that here, Mike, just that demand plus the talk of China bringing in Argentine corn as of July, I believe, is the rumor in the trade. I mean, stuff like that. Just overall, the corn picture. I guess I'm not loving it. I'm not as concerned as I am maybe with soybeans, but I'm not loving the corn picture right now either, Mike.
No, I'm not either. And that's where, it easily followed the wheat market. And we've got that wheat corn spread now almost at $2.40 premium, the soft red wheat, the SRW market in the lead month July contract. That would suggest to me that if the wheat goes up again, the corn it should willingly follow the wheat because you've got such a wide spread now and premium built into the wheat complex. What this chart really kind of visualizes nicely is how similar we could be to 2013 heading into 2014 as far as 2023 heading into 2024. And we've seen this move to the upside in early 24 like we did in early 14, and then we kind of capped our gains. Why? Because the wheat stopped going up, and all of a sudden we had a lot bigger economic issues. The Chinese were having tough economic issues, and then the Europeans came in with their austerity program, and that really knocked us down. Essentially, we went really into the doldrums of the commodity prices from essentially late 2014 all the way to pretty much the pandemic and the change in Fed policy. And so I don't think we're in that situation. The IMF just came out today and raised the Chinese GDP to 5%. But I will say, Jesse, I probably wouldn't be talking like this right now if it weren't the fact that the wheat was at $7 in soft red or had just hit $7 and 7.20 in the hard red. And that we're at the $7 handle in wheat. We're at the $12 handle in soybeans. I don't want to screw up making money for the clients and getting and locking in a profit, because I see potentially this chart especially suggests to me, and the prior chart suggests potentially to me, you could go 60, 80 cents either way in corn. You could go $1.20 either way in wheat. You could go almost $2 either way in terms of soybeans, depending on what Mother Nature does and what this inflation mindset is in the next 30, 60 days. And that, again, goes back to, if we can put a trend reversal in the US dollar, I think that would really reignite the upside potential. So most of what I'm doing right now to protect profit is in the form of paper positions of puts at this stage for clients.
We're talking with Mike Zuzolo from Global Commodity Analytics here on Market Talk today. One other quick chart on the corn side. I know we shared this world corn ending stocks to use and looking at that ratio too. I think this just kind of adds into what we're talking about here. I would say out of the three, though, to me anyway, I feel like the corn side of things, we got a lot of beans. We know that. Corn's maybe a little friendlier, I guess, Mike. I'm not sure.
No, I think that's exactly right. And this is where that, move of 60, 80 to 80 cents is kind of where it really resonates, and is kind of this genesis of it is we've now gotten to a new 9-10 year low in stocks to use, not by much, but we're closer to 25% than we have been in the last 5 years. And therefore, we're back to where we were in 13-14 time period. If we see Center West Brazil get knocked around again this month as they get ready to fill their final second corn crop out, which that still looks to be happening. In other words, the drouthy Center West Brazil is not giving up. It seems like it's still intact, and I would not be surprised to see yet more production declines for Brazil as a whole because of Mato Grosso and Center West. And then all of a sudden, could we be closer and moving down towards 22% stocks to use ratios like we were in 2013? I think that could provide a 6 to 80 cent rally, as opposed to the wheat market rebuilding stocks, the trade thinking we're back up and seeing a replenishment of supplies, and the corn goes back up a little bit. That could open us up to 60, 80 cents downside between now and harvest, in my opinion.
One more grain chart for us here real quick, Mike. On the soy side, looking at November beans and some value levels here. And I know with beans, I'm a little more concerned about that chart. I mean, how many days did front month July, for instance, reject 1250? That felt like a sign to me. But what are you seeing here in terms of Novi beans? Let's think new crop here a little bit more, Mike.
Yeah, this is the big deal here because we're back below $12, and that's just such great profit. And we do have a gap still up around 1240 from late last year that I was hoping we'd go up and fill, led by the wheat and the corn. But the nuts and bolts for me on this November bean chart, Jesse, is it's going to be really tough for the beans to fill that gap and go above these recent highs that we made in the month of May without wheat and corn really turning around. Because look at what the July and the August beans are now. They are exactly the same price. We have taken out the premium in the July. There is no inversion anymore in the July, and now we're starting to see only a 13 cent premium, I think. Yeah, 13 cent, 15 cent premium in the July versus the November. If we go back to a carrying charge market in July versus November, and July becomes discount to the November, that's a very negative sign typically as far as the supply demand fundamentals. So I again would reiterate, there's a lot of crop year left. There's a lot of drowned out spots in soybeans right now that probably won't get replanted. And so I really am conscious of that. But I think the put side of the equation is exceptionally important. And I think this chart really can show why we could go, down $1.50, $2 relatively easy, or up $1.50, $2 relatively easy, because we're just in a sideways band and we're kind of in no man's land. But really at this time of year, heading into the 1st of June, it's about profit to me.
Let's talk livestock real quick before we wrap it up, Mike. I know the cattle trade kind of really gave back everything we got for gains on the board on Tuesday, especially feeders. What are you seeing right now with that feeder fat spread here?
Yeah, the cattle and feed report to me, Jesse, was much more favorable to marketing's number at 110%. It said that the packers were in buying, the consumption was good, the consumer demand was good. Airline traffic was, I think, a record over the Memorial Day holiday. I know it was on Friday. I think it was 2.9 million people the TSA checked, and didn't see the final number, but I thought I heard it was a record for the holiday weekend. So consumption was strong. The cattle and feed report supported that. We are much more current in marketings thanks to that marketing number of 110 in April. But as a result of that report, the feeders were the ones that took over the leadership position after the report, and we saw the feeders go $80 premium, $80 plus premium on Tuesday, lead month against fat cattle, took out the 2014 highs. We've come back below those 2014 highs now as we closed out Wednesday with a real nasty turn of events in the feeder complex, almost a $5 shift in prices and range in prices on Wednesday. I just don't like the feeders leading this market because of this chart, and that's especially given the fact that the feeders were rallying on weaker corn. And when we saw it turn negative, I think this chart was really the major cause of it. We've got a cash market that's probably not much better than 250 based upon what I'm seeing in Oklahoma and key areas of Missouri. And it's a little higher in Nebraska for 7-weight feeders, but I think 250 captures a lot of the 7-8 weight feeders at this point. August feeders on Tuesday we're trading 264. So why would the feeder futures be leading when the CME cash index actually lost some ground on Wednesday's trade?
Well, good thoughts. I know we're going to get up against the clock here, but always appreciate the insight. Hog trade was down slightly Wednesday. That market's been tough. Something to watch there. I did want to ask you this question real quick. We did get a listener question for you on our YouTube channel. Wyatt at Hill Country 11. He asked, as we seem to see a daily overnight push in grain prices, only to see it drift lower into our trading day. He wants to hear from you if you think there's an arbitrage trade going on similar to the gold and silver markets, thus artificially suppressing prices here. Any immediate reaction to that question?
Yeah, it's a really good question because it, I think, really does highlight the currencies right now, Jesse. And I think if there's an arbitrage trade going on, it's between the European wheat and the United States wheat. And that stronger dollar is giving the U.S. wheat the short side of the stick. And the EU market has not broken nearly as much as the U.S. has this week. And in fact, I talked to a client in Europe yesterday, and he said he still thinks there's more declines coming from France being too wet, and there's still issues in the Black Sea, as you and I talked about today. But it's about the euro, it's about the currencies, and it's about that Japanese yen carry trade as well. That's been a very big player in how commodities are traded, as far as loaning money in one currency to be able to trade it in another currency. And I think that is what maybe Wyatt is feeling. As far as the gold and silver and copper go, I think they're just in that general risk off attitude right now, because we've seen the copper pull back about 5.5%, gold about 3.5%. I think they're very nervous about what the Fed mindset may be portraying after Friday's PCE numbers in the bond markets. That higher bond yield, higher dollar, I think, has really got the metals nervous like it does the grains.
Mike, always appreciate your time and the great analysis. And folks can reach out to you with questions as well, and take a look at a free trial and much more, a 2-week trial of your work. Where can they find you, Mike?
GlobalCommResearch.com. It's GlobalComm with 2 M's, research.com.
Mike Zuzolo, Global Commodity Analytics. Always a pleasure, sir. Thanks for joining us. Have a great week.
Thanks, Jesse. Appreciate you having me.
Make sure to subscribe to the Market Talk YouTube channel. You can watch our latest interviews with top market analysts in the country, find bonus content, and much more. It's easy. Just go to youtube.com/@MarketTalkAg and hit the subscribe button. Or you can search for Market Talk Ag on YouTube.